In a SaaS enterprise board meeting, a product lead might proudly declare to the group, "We have achieved 1 million in monthly recurring revenue." The room is filled with excitement and pride, until the CFO says, "This 1 million is not 1 million in traditional recognized revenue, at least not in the way we define it in finance." So the difference between monthly recurring revenue and traditional revenue is more than just a naming convention. It's a minefield for SaaS companies. Hello, my name is Alex and I build B2B products at SAP and Signavio, and this is the second episode in the Key SaaS Metrics and Analytics series. In this video, I want to talk about monthly recurring revenue, or MRR, one of the most fundamental and misunderstood metrics in SaaS. We'll break down what it really means, why it matters, and how to make sure you are not just tracking it, but using it to drive better decisions. To quickly define terms, monthly recurring revenue is a normalized and predictable revenue number representing a forward-looking run rate of the revenue your customers pay on a subscription basis. GAAP revenue, which often referred to as revenue in a finance organization, is the official recognized revenue number on your income statement for a defined period of time based on generally accepted accounting principles. In other words, MRR is about momentum, while GAAP revenue is about realization. The problem is, because MRR is so frequently used as a stand-in for growth, it can sometimes be thought for like revenue. This can cause confusion and lead to incorrect decisions. In the context of the enterprise, where contracts can be large, long-term, and subject to strict accounting rules, the difference is particularly significant. The contracts can be very complex with variables like start date, deferrals, custom fees, and long-term commitments. As a result, the difference between the two metrics can mean millions of dollars at stake in terms of planning and setting expectations with investors. Even for seasoned startups with their CFOs on board, mistakes can be made with non-GAAP reporting, which can put the company at risk for missteps and damage to the reputation. Let's take a closer look at the rationale for MRR is not revenue, including a couple hypothetical examples of how these mistakes can be made, followed by a quick checklist to ensure that you are avoiding these pitfalls, and finally some best practices for communicating the context of MRR with the various groups within the company. So let's take the following situation. The product team at an enterprise startup SaaS product experienced a 15% increase in their MRR for a particular quarter. This was due to some large annual contract deals that were closed and counted towards their new subscription numbers. The product team is excited about their MRR growth and is planning to scale up their infrastructure and customer success team, assuming their revenue will continue to grow at the same rate. This is because their MRR increased by 15%, so they will make 15% more money each month, right? But actually, this is where the product team made a critical mistake, since their GAAP revenue for the particular quarter increased very little. Why did this happen? The large deals had annual upfront fees and complex start dates. For example, one deal was worth 120k per year but started midway through the quarter, so the finance team only recognized 60k of revenue for that particular quarter, due to revenue recognition rules, not the full 120k run rate. Another deal had a one-time fee for professional services, which was included in the MRR calculations but is not recurring revenue. The cash was not collected at the expected rate, since some invoices are still pending. The product team fell into a common trap of assuming that 15% increase in MRR translates into 15% growth in revenue. The overestimation causes budget problems. The CFO is now worried that they have been spending money under the assumption that revenue will be generated, but that revenue hasn't been generated. The product leader is in the awkward position of having to explain to CEO why, if they have achieved a record MRR, they haven't seen that translate into a corresponding increase in revenue or cash flow. There are many worried stakeholders in finance and elsewhere in the company. Did we misunderstand the entire state of the business? The good news is that we can learn from our mistake, and we realize that we need to rethink how we use MRR internally as more of a momentum metric rather than a direct revenue metric. We can adjust our models so that we are planning based on GAAP revenue and cash flow, using MRR as a metric to understand growth revenue trends. We can also learn our lesson. MRR is a great metric, but it is not money in the bank. So what should be done? We need to recognize that we need to tighten up our process with finance. Anytime MRR is brought up in any of our planning models, we are going to be sure that we are also looking at GAAP revenue and cash flow. We will work with our CFO to provide a bridge report that shows how MRR translates into revenue and cash flow. Over next quarter, we're gonna be hosting a meeting throughout the entire team on just that topic. How does $1 of MRR translate into revenue? Another scenario can look like following. The VP of Sales walks into the quarterly board meeting and presents a slide that boasts $5 million in revenue this quarter, based on the high MRR numbers from recent enterprise sales. The board and investors raise their eyebrows at the large increase in revenue. The CFO and finance team try to clarify that the company's GAAP recognized revenue for the current quarter is nowhere near $5 million. In fact, it is substantially less when deferred revenue is taken into consideration for multi-year contracts. This $5 million is actually a run rate based on current MRR numbers, extrapolated into the future. So what went wrong here is that the communication breakdown occurred when the VP of Sales, along with product stakeholders who contributed to the creation of the report, used the words revenue interchangeably with the company's current MRR numbers extrapolated into the future. The large deal that contributed to the $5 million run rate was actually signed at the end of the quarter, so only a fraction of it was recognized as revenue in the financial statements. Such wake-up call also means that the company can do a better job of educating the team. For example, the VP of Sales and the product team can work with the finance team to ensure alignment. They need to understand that, for example, MRR is a snapshot of the revenue momentum as opposed to GAAP revenue, which is the revenue that was actually earned and recognized. So how can you determine whether you are confusing MRR with actual revenue? Sorry for starting from the very obvious thing, but using the term revenue instead of MRR is one of the factors. In general conversations, listen to whether people talk about revenue growth of 10% and so on. Are people referring to MRR when they say that? Be very careful with the use of the term revenue instead of MRR. For example, when people say that revenue is up by 100k this month because of the new deal, but in reality the 100k is just the contract value, which can lead to false expectations. The second typical mistake is MRR growth versus GAAP revenue. Compare the actual revenue with the MRR growth. If the MRR multiplied by 12 is not close to the annual recurring revenue or the last 12 months of GAAP revenue, there could be some issues with the way you are handling the metrics. Inconsistency between the growth in MRR and the growth in GAAP revenue could indicate that you are misunderstanding the metrics. Then there could be one-time charges included in MRR. One common mistake is to include onboarding fees, service charges, and so on in the MRR. MRR only reflects the subscription revenue. One-time charges should not be included in it. For example, when the big upfront implementation charge is causing the MRR to jump up, in reality you are not seeing the MRR grow. You are seeing the one-time charge. If you notice that you are only collecting 70% of your billed MRR in cash, then you have a problem. Either your MRR model is overly aggressive and counting revenue before it's been earned, or your accounts receivable process is broken. Additionally, if you are announcing record MRR while your customer churn and downgrade rates are increasing, then you should probably recheck your numbers. Healthy growth in your MRR should be correlated with low churn and high cash collections. Do finance, sales, and product each have their own version of MRR? This could be true if sales operations uses ARR and measures it as revenue from contract value signed, product analytics uses MRR and measures it as billed usage, and finance uses GAAP-based deferred revenue schedules. If each team's dashboard is showing different recurring revenue numbers, then you have a problem that should be addressed. For example, sales operations might be measuring an annual contract value of 240k as 20k MRR from day one of signing, while finance doesn't start counting any MRR until 3 months later when the service goes live. This means that for 3 months out of each year, sales operations will be reporting MRR that is higher than finance reports. So what are our key takeaways from today? First, educate and align across teams. Make sure everyone from the product managers to sales reps to finance analysts understands the difference between MRR and GAAP revenue. Don't assume each function automatically gets it. Second, provide context with every metric. Whenever you present MRR in a deck or an email, add a brief explanation or pair it with another metric. For example, our MRR is 500k while our GAAP revenue this quarter was 1.3 million. By consistently providing both the forward-looking MRR view and the backward-looking revenue actuals, you paint a full picture. Third, tailor communication to stakeholders. Different stakeholders care about different aspects of revenue. A VP of product might be interested in MRR as a sign of product market fit and growth in usage-based revenue. The VP of sales might focus on ARR and bookings for hitting sales targets. The CFO and finance team prioritize GAAP revenue, cash flow, and profitability. When communicating across the org, frame the message for what matters to your audience but still clarify the type of metric. Then maintain consistency and transparency. As your company grows, consider adopting standard definitions and stick to them. More importantly, be internally consistent. If you change show you calculate MRR, say to exclude a certain type of fee or to include a new revenue stream, inform everyone and ideally restate historical numbers for apples-to-apples comparison. Don't be afraid to celebrate MRR milestones, just do so responsibly. It's great to rally the team around reaching a new MRR high as a sign of market traction, but in the same breath acknowledge what it means and what it doesn't mean. This was the second episode in Key SaaS Metrics and Analytics video series. In the next one, we are going to discuss why churn is a lagging indicator and what to look at instead. In particular, we're gonna talk about such leading signals as usage decay and role churn. Thank you for watching, and remember, clear metrics aren't just nice to have, they are what align the boardroom and the team room.